Insider trading is when someone who has access to confidential information about a company and its stocks uses that information to take advantage of the stock market by trading or selling stocks or securities for financial gain. This use of information violates the duty of the employee on behalf of the company and is unconstitutional. The intent of the stock market is to reward the investors who can make the best judgments about investing and selling securities. This intent is harmed when a minority of the market takes advantage of this information that the majority did not have access to. This could also be an employee sharing this information with friends or family, which could also give them an advantage in this stock market. A non-employee who received a tip and engaged in insider trading is just as liable for insider trading as an actual employee. The federal law considers an insider as someone in the company who owns at least 10% of the company's equity or securities. Companies are required to report insider trading by corporate officers, directors, and other employees with access to confidential information to the SEC or publicly disclose it. Economically, insider trading is also undesirable as it increases the cost of capital for securities traders, and it also depresses economic growth. This law is cited in the Securities Exchange Act of 1934, which created the SEC and also gives the SEC power to regulate transactions of securities in the secondary market. This act was passed shortly after the 1929 stock market crash with the intent to restore the public trust in the stock markets. Section 10B of this act is the primary anti-fraud provision, which prohibits the use of any device, scheme, or artifice to defraud. Rule 10B/5 also includes liability for any misstatement or omission of a material fact that the investors would think is important to the decision to buy or sell a security. The Dirks vs. SEC case was created. It created the constructive insider rule, which treats individuals working with a company as insiders if they have access to confidential information. The Insider Trading Sanction Act of 1984 and the Insider Trading and Securities Exchange Act of 1988 provide penalties for insider trading. These laws made the penalty for insider trading up to 3 times the profits gained from the trade and up to 20 years in prison. However, the maximum criminal fine for an individual is $5 million and $25 million for businesses. In one especially high-profile case, a hedge fund manager was sentenced to 11 years in prison and ordered to pay $156.6 million in penalties and fines. So before you invest in the stock market, just make sure to familiarize yourself with the corresponding laws. Insider trading is a serious crime, and it is easy to be caught. The SEC is always monitoring trades for suspicious activity. The penalties are steep, and it makes more sense to just try your luck investing legally like everyone else.